Good morning and welcome back to Almus Market Mornings. It just takes one data point to really shift markets outlook. Last week, it was the non-farm payrolls that caused this shift. Before the non-farm payroll, however, the Fed meeting and Chair Powell's commentary had investors reduce the odds for a September rate cut. Inflation elevated, job market in good condition kept investors wary of betting on aggressive rate cuts. The sharp revision in NFP and slight uptick in unemployment rate gave the confidence that yes, labor market is weakening and labor market is something closely watched by the Fed since they have a dual mandate of inflation and employment. But after the release, President Trump soon removed the chief of Bureau of Labor Statistics, the entity which publishes this data. Let's understand from JK what all of this means. First of all, JK, congratulations to all of us at Almus. It's Almus's 13th birthday. As a founding partner, you must have seen quite the journey.
Good morning, Swaraj. Yes, first of all, congratulations to all the admissions, and thanks a lot to all our followers and clients, who have been supporting us all through these 13 years in rendering the service. And we seek your wishes to continue to the same, so that we move together in managing the market risks in most effective way. Yes, Friday was somewhat, I would say, a unique day in which, all through the day it was looking like, dollar was recovering, and, perhaps the concerns about the economy was not so high. That was how the data so far had been indicating. But the most important data which the Fed and the government also tracks is the jobs data, and monthly jobs data not only came below expectation at 73,000, but there was a huge revision, as you said, of 253,000 for the previous 2 months. And this was a shocker. And along with that, unemployment rate also going up. Market was taken by big surprise. And the moves later also were huge. And no doubt, this puts a lot of question on whether the going forward, Powell can maintain his stance that we will wait for the inflation to show up, the tariff-related price pressures, or whether we should focus on the economy. And that is the big question that the market is trying to answer. No doubt, the markets have already started to discount a rate cut in the month of September. That is about it's a 80% chances. And just on Friday, we had shared that the probability has come down to 40%. And there was a huge move in the yields all across. And of course, the 2-year was the biggest mover, moving down 33 basis points. And the yield curve also steepened because of the shorter end moved much less. Yes, there was also news that one of the Fed members also had resigned well before the term ended, and Trump is also already planning to appoint a new member in her place. In the meantime, the two members who had dissented for rate cut in the previous meeting in Fed, that is, they had opposed, they had dissented maintaining the holding of the rate. Mr. Bowman and Valor, and they once again reiterated their stand that rate should be cut immediately, saying that waiting to cut threatens the economy. So there is definitely immense pressure on the Fed to act much earlier. So we would wait for what reaction we get from other Fed members as well as Powell in the coming days to know whether we really have a rate cut. But market has already started to, price in the rate cuts, starting September. Some say that it can be even a hefty cut also. The market actually ignored other data which was there on the ISM manufacturing, which was, the headline was slightly better, but then the employment showed deterioration once again. And so market is really now clearly looking at the rate cut prospects. Dollar had a big move on the downside. It was looking like dollar could gain more in correction, but then it was a U-turn for the market. from under 1.14, euro went up as high as 1595, almost a 1.5% movement. And dollar index itself also came down from 100 plus to close to 99. Dollar yen dropped from above 150.50 to almost 147. It was a very big move on the dollar, and this, of course, it tries to raise the question whether we have already resumed the dollar bear trend after technically satisfying the 26.8% retracement as per the technical requirement. But however, we will have to see what Fed reactions come about, and no doubt the job number is going to have the biggest influence as far as the rate prospects are concerned. Stock markets also took it on the chin, because now perhaps the big expectation that the economy is slumping is something that probably showing up in the actual numbers, and that is why the markets, which are already overheated, we had a stupendous rally from April 9th, when reciprocal tariffs were postponed for implementation to July 31st, and that July 7th, and that actually now is probably be shown up in the economy, and that is the reason why market is starting to not only short the dollar once again, but also to sell off the big positions in the stocks which they have built up over the last few days. There is a question mark how the economy will perform. Of course, we'll have two more inflation numbers and one more employment number before the Fed meets next in September. But possibly, now it's definitely in balance tilting in favor of a rate cut. On the rupee, as we had said, we had somewhat an oversold condition for the rupee against the USD, touching 87.83 in the offshore market last week, and of course it was almost 3% move from the lows. RBI was seen selling on the last two trading days of last week on Thursday and Friday, and the market cut some of their long positions ahead of the key data. And of course, in offshore trade, we did not see a drop in the dollar rupee below 87.20, which was also seen in our time, and perhaps the 87 to 87.20 offers good support for the dollar rupee. Dollar rupee has its own issues from the Indian point of view, because the tariff at 25% and also the penalties for Russian oil import, these are overhanging factors, and FI flows have continued to be very large in the last few days, and last week alone we had almost 1.5 to 2 billion of FI flows from the equity and the bond market. So rupee will not get immediate relief even the dollar is going down. We will have to see what kind of negotiations and relief that India gets, that Indian side gets on the tariff and other trade deals. So rupee will trade between 87 and 87.80 for the time being. Dollar also, perhaps, even though despite this news, the dollar's oversold condition has not yet been fully addressed. So we might see even consolidation in the overall dollar also, leading to some more consolidation in range trading. And of course, we will wait for more triggers and more data from the US economy. Thank you.
Thank you, JK. And it seems quickly all game is now being played on market expectations of rate cuts. We are seeing a sharp U-turn in dollar, especially after the rate cut probabilities jumped from 40% to 80% for a September rate cut. We saw 2-year yields, they fell over 30 basis points. We are seeing these kind of large moves after the employment data that was released. Euro rallied almost 1.5% against dollar. We are seeing dollar weakness all across the board. Of course, when it comes to rupee, we have our own challenges. So the rupee has not strengthened a lot. So it's still at 87.20 as of now, even in the offshore market. We have our own challenges, FI outflows, and possible sanctions on Russian oil purchase. All of this keeps high degree of uncertainty, and rupee also weaker. So we'll have to see how tariff-related updates play out for us as well. That's it from us today. Thanks for listening. We'll catch up tomorrow with a fresh round of updates.